I've spent more than 270 minutes this week trying to learn and understand liquidity from a forex perspective. So let's get into it. My understanding of liquidity is slightly different from what everybody's teaching on the internet, and I just try to put it into normal people words and just an understanding from economics 101 pretty much, right? And so trying to bring it back to how I studied, what I can say is that liquidity pretty much is waiting until there is less buyers in the market and more sellers in the market so that you can buy the market, right? So you want to buy something at a cheaper price where there is more sellers and less buyers, right? And you find those levels based on previous price action, and then vice versa for sell-offs, right? And that's my basic understanding of it, just taking it back to like supply and demand essentially. But going into like specifics about liquidity, what I found was in my research that based off from ICT concepts, majority of the forex gurus state that liquidity is found above and below previous monthly highs, above and below previous weekly highs, above and below previous daily highs, and above and below previous session highs. Which of those are the most effective? I'm not too sure at the current moment, and that's what the next week is for, the next week and a half. How does it actually affect our trades? I'm not too sure. I can't particularly answer that at the current moment. But what I can say is that there is an alternative theory in comparison to ICT. And essentially what it is that you kind of playing against the retail traders thought process. So if we're in an uptrend, we're making a high, a higher low, and a higher high that broke the previous high. So we had a breakout structure. Then your anticipation is that we're going to make a higher low and then a higher high, right? So when we have those two higher lows, and this is something that I learned on, I'm not too sure, but I'll see if I can find the YouTube channel because it's really good. But when you have those two higher lows, essentially what you have is a uptrend. And if we think about liquidity in a sense where it's inducing, or it's just an opposite thought process of the way classic retail traders trade, classic smart money traders trade, then what you're going to do is you are going to assume that now, because we are in an uptrend, that these lows now that were created, these two higher lows that were created, is more likely than not going to be swept, and we're going to go all the way down there. Why? Because as I mentioned, we need more sellers in the market so that we can buy at a cheaper price. And finding those prices where we're going to buy at is dictated by previous swing lows or previous swing highs. In this case, it will be previous swing lows. And that's what I found interesting, is that instead of following price action and having your order block or your fair value gap dictating somewhat of liquidity, because those are liquidity drivers, I want to call it, but what you can find is that you can use the opposite end of that and say, this is where my order block is, this is where my fair value gap is, at the basically the deepest pullback that you have, and you can anticipate that that should get swept and taken out. And then once you start to see that reversal after it gets taken out, you can now start to anticipate that you are going to have a displacement or distribution in the direction, or in the opposite direction of the sweep basically. Thank you for watching Liquidity 101 from your boy Marcy at the Modern Day Trader. Peace out, man.